Hi, thank you for joining us today. My name is Valerie Ho. I am a co-portfolio manager on the International Fixed Income team, and today I'll be moderating today's discussion, Traveling the Globe. I am joined today with my colleagues from the International Fixed Income team. I have Luz Padilla, Director and Portfolio Manager of the Emerging Markets team, Mark Christensen, co-portfolio manager of the Emerging Markets Strategies and co-director of corporate research here at DoubleLine, and Bill Campbell, co-portfolio manager of the DoubleLine Global Bond Fund Strategy and the DoubleLine Emerging Market Local Currency Strategy. Thanks for joining us here today. As the title of this session indicates, we are going to travel the globe and discuss the risks and opportunities you're currently seeing today across international fixed income markets. So we're going to have about a 45-minute discussion. We're going to leave about 15 minutes of Q&A for the audience. And I believe that there is a chat feature in which you can submit a question. I believe that all those questions are anonymous, so please, we want this to be a lively discussion. We want to have a lot of feedback. We want to know what our investors are thinking. So please submit your questions and we'll try to get to all of them at the end. So we are about 15 months into this global pandemic, and we've seen a multi-step recovery this year in 2021. Part of the reason that we're seeing uneven recoveries across developed markets and emerging market economies has been the unequal access to vaccine. So Mark, I want to ask you this. What has been some of the biggest challenges for emerging markets in terms of vaccine procurement and getting a large portion of their population vaccinated?
Yeah, thanks, Val. There's several points, and the first that I would make, I think initially it was and still somewhat ongoing, governance. Many emerging market countries were late to the table to garner supply of vaccines. Those that were successful, there were a few: Israel, Chile, wealthier countries than many of their EM peers. They were much more aggressive in resourcing vaccines. Chile participated in trials and so forth to make sure they had a seat at the table. And so they're right up there at the top with the developed markets, and at 62% for Israel vaccinated at least with one vaccine or one shot, and 44% for Chile. However, the rest of the countries seem to have kind of put the issue aside, thinking, well, this isn't as bad as it's going. We don't think it's going to be as bad as it seems like it'll be. They were late in making decisions and so forth, and so it put them in a back seat to the developed markets. Now, not all of it's their fault. Lack of supply. Most of the vaccines are being created outside of, say, China. India's got China has its own vaccines. India has vaccines, but most of the rest are coming out of the developed markets. And what's happening is countries where are keeping the supply. So the U.S. has basically held on to its vaccinations until they find that we're at a point where we feel like we're fully vaccinated here or have enough to share. We're also a big supplier here in the U.S. and some of the developed markets as well of the ingredients that go into the vaccines. So countries that, even though they have production available, can't resource in the emerging markets, they can't find the resources necessary. India was a big supplier of emerging markets up until the point where their COVID blowout, unlike ours in the West, was over the late into last year, early part of this year. Theirs is just now hitting. So they've backed off giving supply out to the rest of emerging markets. So there really hasn't been a lot of supply. So some countries didn't take it so seriously at the beginning. They didn't procure what they needed, and then supply just hasn't been available because developed markets have kept it until they feel like they're fully vaccinated. And additionally, we've got the Kovacs Initiative, and that was backed by the World Health Organization and wealthy countries to ship vaccines to the poorest of the countries in the globe. And up to this point, they've shipped 59 million vaccines to date, and that's against 278 million doses administered already in the U.S. And that organization's had difficulty in procuring vaccines. It's estimated, so that's the biggest issue. just supply. There's not a lot of supply out there, and until the developed markets get through their cycle and get people vaccinated, and then have excess supply available to start shifting down to the emerging markets. It's estimated that by year end, 90% of the developed markets will be vaccinated. I'm assuming we're talking about here, our assumption here is adults. And I know we're starting to move our way down into younger youth. And only 30% for emerging markets by year end. So by our estimates, Valerie, we're looking at maybe a 6 to 18 month delay in each of the emerging countries, depending on which country it is. So I'll leave it at that. But those are some of the issues that emerging markets have faced in getting vaccines.
Thanks, Mark. Yeah, so I think we have about 8% of the world population currently vaccinated, and it feels like we have quite a long way to go to reach that so-called herd immunity across the globe, as this pandemic really isn't over until it's we have the globe vaccinated as opposed to each individual country. Keeping along with the theme of global risk, Bill, I want to bring you in. This morning, we got a big upward surprise in inflation. Headline inflation hit 4.2% on a year-over-year basis. The Fed and Chairman Powell has been saying that, this pickup inflation and in prices will be transitory. What are the risks that, these pickup in prices that we've been seeing will have some inertia behind it, that these higher prices could be more durable and we could see higher inflation in the future?
Thank you, Val. And you pointed to, I think, what is one of the most hotly debated questions in markets right now. The Fed is kind of wedded themselves to the idea that the inflation increases are transitory. And the reason for that is the base effects from the deflationary shock that we experienced immediately after economic lockdowns happened last year due to the pandemic. What we saw today is not only did we get the expected increases due to base effects, but we surprised to the upside. We've seen supply chain disruptions, and we're seeing commodity price increases that I think there is a decent debate as to whether those can clear up once we put the pandemic behind us. But I think there's another element that's happening here, and we need to pay attention to how the policy response to this crisis is different from the policy responses to the last crises that we've seen. The way that the policy response to this crisis is different is policy targeted getting cash to individuals' hands. As we know, consumers spend. In past crises, we've seen central banks increase the money supply, but it got trapped in the banking system, and tepid loan demand created a headwind to generating higher inflation outcomes. I think to get to the answer that we're all looking for, we're still going to need to get through the next couple of months of base effect inflation and the residual supply chain issues that were either caused by the Suez Canal or by people not being at work. But I think the item that we need to focus on for the durability of inflation is, what is the future policy that is put forward? Do we see policy that continues to target putting more cash in consumers' hands, or does that policy get cut back a little bit and we go back to the old policy? It's an open debate. I think that's the key element to watch for if inflation is going to have the transitory nature that the Fed is looking for versus having a more durable outcome that the Fed will have to react to, as well as other central banks are going to have to react to.
Thanks, Bill. And when we look at the market reaction today to this higher than expected inflation print, we see higher U.S. Treasury rates across the board. What's the impact of higher rates on emerging markets, and what will the headwinds be if the Fed needs to push forward its discussion on tapering or future rate hikes?
Sure. So the first order impact of U.S. rate increases is tightening financial conditions, but just increasing the negative headwinds from duration impacts. So as rates rise, bond prices fall. The other headwind is as rates rise, financing conditions become much tighter and growth becomes constrained. So what we really need to pay attention to is not the rebound effects that we're seeing now from the closures that we saw at the beginning to middle of last year, but if, similar to the inflation story, can growth maintain its path to a durable recovery, or does growth also start to reprice lower? If growth starts to reprice lower and rates are pushing higher, that can lead to an environment that will be a headwind for the emerging market asset class. On the other hand, if we see vaccine rollout helping growth come back, we see an infrastructure build out in the West and in China that supports more commodity demand from emerging markets, and we see emerging markets be able to tap into the new supply chains that might be formed around new technologies that are being brought forward, we can end up in a situation where, although bumpy, emerging markets, I think, will price that growth reflation in. So as long as the rate increase is not in a short period, as long as the rate increase is accompanied by sequential growth, positive growth outcomes, you can kind of mitigate some of the financial tightening risks that higher rates do pose to international markets.
Great. So the speed of the backup certainly matters, and sequencing is something very important that we should be paying attention to. I want to pick up later on some things that you mentioned if we have time on the commodity cycle and all green energy, but I want to make sure we get to the rest of our questions today. Turning to Luz, so in 2020, during the first months of the pandemic, we saw emerging markets as well as developed markets deploy huge amounts of fiscal and monetary stimulus to help combat the effects of the pandemic. What was a little bit unusual in this crisis is that emerging markets for the first time was actually able to deploy quantitative easing during this crisis. So this is a first for emerging markets, essentially almost graduating to the status of developed markets. Now, as we are, well into the year of the pandemic, but there are still rising cases within emerging markets. How much fiscal space do emerging markets have if they need to deploy further fiscal measures in second or third or fourth waves of this pandemic? Maybe a more broad question, do debt and deficits matter today?
Thank you, Val, for your question. I think definitely, debt and deficits do matter. As you stated, in 2020, there was unprecedented support across the globe. Emerging markets were also included in that. And I think largely because there was a lot of space that they had. Again, each country has its own individual set of numbers, but by and large, I think most countries were able to, provide significant support. In 2021, it becomes more challenging as, they've used up some of that space. However, I think one of the things that, that maybe we're not focusing on as much is the fact that as we see a recovery in developed markets, that is actually supportive for emerging markets as we see, an increase in exports and commodity prices. And so I think that is going to be helpful for emerging markets going forward. And that's something that certainly they did not have in 2020. Now, we've seen countries already try to withdraw some of that support, and that has not gone over very well. Colombia is probably the latest example of that. And we started to see some social tensions develop as the country tries to withdraw some of that support in order to shore up their numbers and maintain their ratings. That's going to be a push and pull going forward. But we do think that the fact that we are seeing a recovery in commodity prices is going to be helpful, certainly for countries like Colombia and other exporters. And so we believe that while it is going to be difficult and it is going to be very nuanced and very, country specific, we do think that some countries certainly have the ability to continue to provide some support. to enable the population to get through this very difficult situation, especially as we expect that COVID, the pandemic, will last longer in some of these emerging economies. And so I do think that there are some countries that can continue to provide support. I do think that a lot of these countries are going to benefit from the recovery that we're seeing in the US as well as in Europe. And therefore, I think there's going to be more space that will be made available to certain countries.
Thanks, Luz. You bring up a really great and salient point that despite the large recovery we've seen in commodity prices, many of the commodity producing emerging market countries have failed to rally, and you pointed to some of the idiosyncratic country risks that are occurring, such as Colombia, Peru. I'm just wondering, what are some of the other country-specific items you're watching? And then on the commodity side, Peru, Colombia, Russia, despite their high linkages to commodities, are some of the worst performers in the MB Global Diversified. When we're thinking about corporates, have corporates also underperformed despite the commodity rally?
I do think it's interesting because I do. You mentioned, are having difficulties because of the election cycle that we're through. Elections, and right now it seems to be, a choice between, somebody that's very far to the left or somebody that's very far to the right. So when you think about, what we may see in terms of the ultimate president in Peru, it's very wide opposing views. However, one of the things that I always look at is, how much can they really get done? And it seems like it's going to be difficult for either candidate to, pass a very ambitious agenda and change a significant portion of its trajectory in terms of, the economy and just underlying sort of fundamentals, simply because they don't really have the Congress behind them. And so I think, it is going to be a shock depending on who wins. And we are going to see some volatility, and we've already started to see it. But, ultimately, as with, I say most any country, most of what the population wants is just better living standards. And I do think that over the medium to long term, that is the trajectory of not only Peru, but most of our emerging economies. And so on the one hand, we have, very specific country risk that's associated with a heavy election calendar. Colombia is one in which, the presidential elections are coming up next year, as well as Brazil. And so again, with, upcoming presidential elections, you're starting to see a lot of candidates sort of, continue to loosen up the purse strings, even though they may not have as much, let's say, availability. However, a lot of these countries are starting from a much better base. And so I do think that they do have some space to continue to provide support. So to me, that's what we're looking at in terms of, the different performance of these countries.
Thanks, Luz. Yeah, certainly the elections in Peru will result in a very binary outcome. What I think is kind of interesting is both, the left and the right both, believe in these social issues and that, social safety nets need to be built up. I think it's just the methodology of how they get there is the big disagreement. And that certainly will play into Peru and its fundamentals going forward. So something certainly to be watching. Bill, I want to turn it back to you. So we've seen a very uneven recovery, as I mentioned, in 2021. It seems that the US, the UK, and China are really leading the way in this global recovery. My question is the growth that we're seeing in US and China enough to lead to a global reflation trade? And what's the impact of China, who is well under its way in recovery, who's now, as you alluded to before, starting to withdraw some of the stimulus and focus on financial stability measures? And then if we could also bring Europe into the discussion, where are they in the recovery phase? Because it seemed like in the beginning of the year, they were really lagging in terms of the pace of vaccinations and opening up their economy.
All important questions. I think what we need to do is put it in the framework of thinking about sequencing the global recovery and the global growth recovery. I do think that other than inflation, we need to pay attention to growth outcomes very carefully, especially as international investors. So what we've seen, as you said, China and the U.S. And the U.K. have kind of sequenced first, as well as Israel, in this recovery. And a lot of that was initially due to the ability of each of those countries to both manage the COVID crisis and to procure and be able to start a meaningful vaccination program that then allowed for reopening of the different economies. I might take the questions a little out of sequence and jump to Europe, because Europe has recently seen an increase in its ability to get vaccine out and vaccinate its populations. We have seen some surprising survey data come out of Europe, both on the manufacturing ISM numbers, as well as, so that's the manufacturing confidence numbers and business and consumer confidence numbers that are showing that the pace of growth is actually picking up along with the vaccination rate. So we had seen the U.S. and U.K. and Israel initially lead, but it's our expectation that going into the summer and coming and through the summer, we should see Europe start to pick up. And as Luz talked about, I think that as we start to see the major economies come back online, that is going to have a pass-through effect to other countries, all the way down to the frontier emerging market countries. But it's going to sequence, I think, through, first of all, supply chains and through trade channels, and also who is able to get the COVID situation and their vaccinations to a point where they can allow a more meaningful reopening of their economy. So I think that that is laying the groundwork for a potential interesting second half of this year trade, in international markets as as this playbook begins to play out. Moving to China, China's fascinating. I think they were able to manage the pandemic, very well. One of the, I think, most underappreciated elements of the recovery, of what we saw last year was not only the growth that China had due to, their export, the trade channel and their export of goods, but was also due to the amount of stimulus that they pushed through, the credit stimulus. When we look at the credit impulse indicators, they pushed to highs that we had seen in previous crises. What we're seeing now is China is, after having a fairly successful COVID outcome and having very successful growth outcomes, is they've started to normalize their policy. We're seeing in fact, the numbers last night showed total social financing numbers that actually disappointed market expectations. That's new loans that were put out in April came in below the 1.6 billion expected out of China last night. So the credit impulse in China is slowing. China is a very politically sensitive country. So one date that we are watching very closely here is the Politburo, which is going to meet. That's the Chinese policy setting body that's going to meet right after the July centennial celebration of the Communist Party. Now, going into the centennial celebration, I think China has all the incentives to just keep everything status quo. But they have already given, sent up warning signals that they are concerned about the leverage in the system. They do want to support the development of their tech sector and their consumers, but they don't want to do that at the cost of financial stability. Now, that's going to be a tricky, I think that's going to be a tricky policy mix to manage. So I think that the first real clues that we're going to get about how that's going to play out are going to come from that, early July Politburo meeting. And China is one of the largest underwriters of global growth, especially for emerging markets. So if the tightening is a little more than expected, we'll have to, look and see where those impacts will be and what countries might be impacted by that. But like I said, they are absolutely going to support their technology sector, which also presents opportunities for those countries that are, linked to, that piece of, Chinese policy. I think, to just wrap it out, the second half of this year, I think, with the reopenings, looks very interesting for, again, the international trade and, non-U.S. Markets. And I do think that there's going to be idiosyncratic risks that we're going to have to monitor, that, China may, be giving a tailwind to some countries and a headwind to some others.
Thanks, Bill. Very clear. A very complicated picture there in China. Mark, I want to turn to you. So keeping on the theme of uneven recoveries across the globe, maybe we can narrow in a little bit more on the corporate sector. So, Bill alluded to the tech sector, which is very important to the, Chinese strategy going forward. Is tech sector a sector that's benefited during this pandemic, or what sectors have benefited and which have been hurt over the last 12 years, and what's the outlook for those sectors going forward?
Sure, thanks, Valerie. Yeah, it's been quite a bit different for each sector. I would lump them into three categories, but I'm going to meaning those that either benefited and saw better numbers, which weren't a lot, but those that were stable. So they they at least remained stable and had relatively flat sales and EBITDA moving through the pandemic. And then most of the rest were in the middle. You saw big moves, from second quarter when you had a lot of the beginning of a lot of shutdowns with improvement in third quarter and so forth, and are on their back into a trajectory toward normality. And even that has a varying, from those that are closer to being stable down to those that are on the weaker end. And then the weaker end, the weaker group, those that really got hit pretty hard. So I'm going to just address the top two, the top and the bottom. Telecom and technology definitely benefited. People continued of the one thing that people would want to have during the pandemic. Most people would be their telephones, and then even for their cell phones. And so then second to that, so those were maintained. And then second to the cell phone was the need to have strong bandwidth at home for those that ended up working from home. So a lot of people upgraded their home bandwidth, which then provided additional revenues and income for the telecom companies. The other part of that is the technology side, and this is when we say technology, we're thinking of those companies that would be in our markets that are the equivalent to like the Amazon. I mean, didn't everybody stay home and order things off of Amazon more heavily than they did, any time prior to the pandemic? I know I did, and so I would say that we didn't see anybody who spiked in the positive direction, but definitely stability. The next group were consumer products, and most of these are the consumer staples. So food companies, beef, there are companies in Peru that provide the U.S. with avocados and blueberries and other food products. Those companies did well. Supermarkets stayed open, and they initially benefited in the first few weeks and months of hoarding, I guess, but they stayed open, so they performed relatively well and stable in the current environment. Utilities, for the most part. Now, there was a little more variation here because we did have, as the pandemic hit, some companies were shutting down, and so less demand for electricity from the business side, but people went home, so they were using more electricity at home. And what we've seen is generally the numbers. There was a little dip for some in that first and second quarter, but rebounds nonetheless because people still need their electricity. So those tended to be at the top end of the scale. I don't think we're going to see. You might see a little. I don't think people are going to reverse their, reduce their bandwidth at home. I think they're just going to get used to it, and people will still keep their telephones, cell phones. So I don't think we're going to see too much of maybe your Amazons and companies like that will see a little lower flow, but the trend was already that way for people to do more purchasing online. So I don't know that there's going to be too dramatic of a tick down with those companies that we saw that were in the stable category. On the weaker end, transportation definitely, and in this category, I'm just referring to transportation. We sometimes will lump into transportation pipelines and things where we're moving commodities through from one place to another. Those did just fine, more utility like. But we're talking about airlines and airports, wholesale shutdown of a business, and so they were affected quite heavily. Ports, the shipping because of just less demand overall reduced. So shipping dropped for a period, and that had started to tick. We've seen that starting to tick back up. Now, we may have ups and downs in these categories for a little bit as we continue to move through the different cycles and waves of COVID. Hotels, leisure, and restaurants, others affected. We don't have very many of these type of companies in both of these sectors do not weigh heavily into our universe. So the sectors that were affected were kind of low on the side of issuance, and those that where you do see quite a bit of issuance, utilities, consumer products, and telecom, more heavily weighted in our universe. So I would say relatively speaking, our markets hung in there. Good cash available to these companies and reasonable debt maturities, and for the most part, we've seen our companies manage their way through the cycle.
Thanks, Mark. I think it's funny how you mentioned, will consumers reduce their pace of Amazon purchases? I'll just give you my anecdotal evidence of definitely not. I can't go back. I'm not going into stores anymore. It's way too convenient to get everything delivered in 2 days, including groceries and electronics and cookware. All of it's being delivered. And I think through the pandemic, my mail carrier was my 3-year-old daughter's best friend, because that's all that she saw during the last 12 months on a daily basis. So I definitely don't plan on going back, just if you need some anecdotal evidence for the e-commerce sector. I want to turn, we've talked a lot about the risk for global markets. Now I want to turn a little bit more to our outlook and the opportunities we're seeing across international fixed income markets, and particularly the emerging market space. So Luz, I want to get your outlook in particular on the hard currency and space. What's your expectations for return for the rest of the year? And how do we get there? Is that going to be through further spread compression or widening? Is it through mostly the change in treasury yields, or are we earning just carry for the rest of the year? And then just in terms of allocation across sovereigns versus corporates, what are you, what's more in favor right now for you? Is there a favorite sector within the corporate that you like right now?
Thank you, Val. When I look at sovereign spreads as well as corporate spreads, we have to put it on historical sort of outlook and basis. So when I see spread for EM sovereigns, basically, average relative to the last 10 years, and corporate spreads significantly tighter than their average over the last 10 years, it has to make you pause and think about, okay, well, what's going on here? And, are fundamentals that much better within the corporate space than in the sovereign space? So one of the changes that we've, thought about and implemented and continue to assess is, are there any sovereign opportunities that we're missing, just given the fact that, traditionally we've been much more corporate heavy. So we are looking very hard at the sovereign component in hard currencies, mostly because of the current valuations, and also because, as we mentioned, we are seeing certainly a lot of these countries are going to take a while to sort of get back to, let's say, their pre-pandemic levels in terms of credit fundamentals. But we do think that given that there is a vaccine available, it will be a matter of time. But we do think that a lot of these countries will be able to vaccinate a large portion of their population, and therefore be able to get through this within the next couple of years. And so as a result, will be able to continue to improve their underlying fundamentals. And so, the current spreads in that mid 300 level seems reasonable. Corporate spreads, however, are significantly tighter than their average. And, part of it is because when we look at, some of the corporate movements, especially, at the inception of this pandemic, we saw very sharp moves, primarily having to do with, a lot of the commodity corporates. And we've seen a lot of them rebound back from very distressed levels to now what I would call, more stress levels. And we do think that sector can continue to improve and has maybe some room to run, especially, again, as we see the positives from the recoveries in the developed market help some of these credits within our space. And so that's a sector, that we have some allocation to. However, we have taken some profits on some of the corporate high yield names simply because of the spread levels. And again, when you look at EM spreads, we can't just look at them in a vacuum. We compare them to, globally similarly rated credits. And on the investment grade side, you're still getting paid for being an EM, primarily at the sovereign level, much more so than you're on the corporate side. And in the high yield space, when I look at the spread differential, it seems like, it's fair and in some cases it's tight. And so it's going to be, again, very nuanced, looking at very specific sectors and countries. And, as we look at what areas of the world have done better and therefore may have an easier path and, have the ability to withstand, let's say, some challenges in the future, just given the fact that, it's very difficult to see a sort of a smooth outcome either way. Like when I think about, what we may see in the future, the fits and starts of, growth, not just in the US, but in EM, where things don't just move in one trajectory, a smooth path, at all times. But do think that there may be some opportunities, especially if there are some sharp movements that we see. And so we're trying to increase the overall liquidity of the portfolio. We're trying to increase the investment grade positioning of our portfolio simply because we don't think we're getting as well compensated in being sort of in the lower end of the credit spectrum. And if there are, opportunities, these positions we're going to be able to better transition out of those into some of the, say, names that may not do as well in a more volatile environment, which, we may see in the near term, especially, just given sort of the very widespread views in terms of the trajectory of U.S. interest rates and the trajectory of not just developed market growth, but EM growth. And so when I look at spreads where they currently are, I think sovereign spreads seem to be, in terms of, historical perspective and relative to their developed market peers, in the fair range. You are still getting some compensation for being involved there. In terms of the corporates, it seems to be, a little bit more, a little bit more expensive. There are some corporates that, continue to compensate you, but, it's going to be very credit specific.
Thanks. And how are you positioning duration within your portfolios, given some of the volatility that we've seen earlier this year in U.S. Treasuries?
In terms of duration, it's interesting because we began the year with, and traditionally have had significantly shorter duration than our index. And, at times it helps and at times it doesn't. Going into the beginning of this year, it certainly was very helpful to be in lower duration assets. And so when we saw a sharp rise in U.S. interest rates, our portfolios were not as affected. And then given the fact that we saw an increase in commodity prices, we saw some of our positions react positively to that, to that move. And so, that combination sort of led us to reassess. And after the first quarter, we looked at where we were and how we were positioned, let's say, relative to not just our index, but, also our competitors. And so we started to lengthen out our duration simply because, again, the moves don't happen just all one way, with no sort of hesitations, if you will. And so, we decreased our credit exposure. So we decreased our high yield exposure. We moved it into investment grade securities, trading maybe some, let's say, credit exposure for duration exposure, feeling that if, rates go back down for whatever reason. And at this point, it's hard to imagine, but it was hard to imagine, seeing U.S. interest rates where they were, before they got there. And so to me, it's like, we are positioned to take advantage of that if that happens. If it doesn't and it becomes much more messy, then I do think that these securities, sovereign investment grade credits, have much more liquidity and much more staying power. And so we should be able to reposition the portfolios, under that scenario. And so we have lengthened our duration relative to, where we were at the beginning of the year. At the end of the first quarter, we started that move. And, we think we've basically positioned the portfolio to take advantage of, volatility if it comes.
Thanks, Luz. I think that's a nice transition to our question on market technicals within emerging markets. So, Mark, what are you seeing in terms of emerging market portfolio flows this year? How are investors positioned, our competitors and EM as a whole? And what's the expected issuance that you and the market are expecting to see this year?
Yeah, thanks, Val. So just to give you a little context, the net new issuance in 2019 before the pandemic was 91 billion. We had a few years back in a decade where it was over 200. But it's been sort of in that below 100 range for some time. But last year with the pandemic, it was quite low until the end of the year when we saw it tick back up. But we finished the year with net new issuance of 53 billion. This year, the expectation is for new issuance is 76 billion. Some of that pent up from last year coming into this year now. So the question I think you've got is from a technical standpoint is, will the market be able to absorb that? And I believe the answer is yes. We're still sort of the sweet spot relative in the fixed income area for those that are looking for yield. And I think our markets continue to become better known, and people continue to become more comfortable with them although it's been 30 years since we've been in the emerging markets, but there are still people coming in and finally seeing that it's value additive to portfolios. So we do think that there's support there for the issuance, the 76 billion this year, and year to date flows that we've seen are 31, almost 32 billion through just the last few days. So we think that that'll be fine. And for the most part, I think that most of the so you mentioned competitors. I can't speak too much for them, but I do think most of the every time we see new issuance out there, it's not like the amount of people interested in the new bonds that we're seeing is less. There's still multiple times books, being held on new bond issuance. So I think there's still a lot of money out there, which means there are still a lot of funds investing money in the emerging markets.
Are you seeing a lot of money from more tourist type investors in emerging markets or crossover money come into the space?
No, the touristy money was kind of geared toward a few select names, I think, where people were familiar with a name that might have a parent that's in both the developed markets and it had pieces in our markets. We haven't seen so much of that lately. Most of the money we're seeing in our markets is true dedicated emerging market money that's dedicated to the emerging markets.
Got it. Thank you. Switching gears just a little bit, again, Bill, I want to get your outlook, both in the short term and the medium term for the U.S. dollar versus developed market and emerging market pairs.
Yeah, so we think that a trade for currencies outside of the dollar is really building. And I think that it's going to follow the sequencing of growth. So we think that we're likely to see the developed market currencies such as the euro, which has already started to appreciate a little bit, and Aussie dollar, for example. The developed markets are going to probably sequence first, and then emerging markets will sequence next, and that will be in line with our expectations for growth and vaccine rollout. In addition to that, I think we need to think about policy changes, and specifically when we're thinking about developed markets, we can think about the difference between the ECB and the Fed in the tapering discussion. The ECB has already come out and stated that they're going to have a discussion at their June meeting of their pandemic bond purchase program. I think what is going to happen either at this meeting or maybe the subsequent meeting is kind of the inverse of what they did a couple of months ago when they increased the pace of purchases of bonds but kept the overall size of the program the same. I think what they're going to try to do is say, we're going to keep the overall size of our total program the same, but we'll decrease the pace. And by the way, that's not taper. And I don't think the market is going to buy that. So that should put support underneath the euro for a little bit more euro appreciation. Now, as Luz said, markets have a way of injecting a lot of volatility and surprises. Now, the surprise could be that the Fed brings forward a taper discussion. I think right now in my mind, I was kind of thinking Jackson Hole at the end of the summer would be about when we might, start to hear about that. But hearing Vice Chair Clarida this morning, where he didn't sound as resolute as Powell did at the last FOMC meeting about, inflation being completely transitory. He did say that the Fed would react if necessary. Kind of opens the door to this, potential discussion by the Fed of taper. It's a little chink in that armor of, that firm stance of transitory. So that is something to keep an eye on for near-term volatility. But that being said, we are medium-term dollar bears. When you look at the amount of stimulus that's been put in the system by the U.S. authorities, it's in order of magnitude larger on a nominal basis than what we're seeing in most other developed economies. And I think what we need to keep in mind is that with the size of this stimulus, and if we do more, we either need to attract foreign capital in to help us fund that deficit, or we got to print to fund that deficit. And in either case, that's structurally dollar bearish. The other element is the large trade deficit that we've been running. Now, granted, what happens is we're running a large current account deficit. So, we're importing more we're importing more goods than we're exporting, and what that basically means is we have to sell dollars in order to buy that. But then what you need to think about is what happens with those dollars. So the international exporter has those dollars and they need to decide what to do with them. Do they want to dump them on the open market and weaken the dollar, or do they want to recycle that savings back into the U.S.? For the past decade, we've seen that savings recycle into the U.S., leading to a large stock of foreign savings that sits in the U.S. that technically we call a large net international investment position. It's a negative international investment position since foreigners own more of U.S. assets than we own of foreign assets. Now, if that stock either unwinds due to concerns about U.S. policy, or you just have the reflexive, as the dollar starts to weaken, more hedges are thrown on. Both of those elements also weaken the dollar. Now, those two items that I just described are the twin deficits that we, are constantly referring to, and that underlie our, view for structurally weaker dollar, over the medium term. So the final element to kind of this jigsaw puzzle is global growth on the medium term. I know we're expecting the sequencing from recovery of the pandemic to happen, but medium term, I think the question is, what is going to be the future growth drivers, for emerging markets that's going to attract capital into those emerging markets? And one element that I would point to is the green infrastructure build out that is now being discussed across the globe. When we look at EV vehicles and the green infrastructure of solar, wind, what is involved in pretty much every step of that production chain is copper. And emerging markets, tend to be, a good supplier, of that commodity. We also are likely to see, a wind down of, the structural overinvestment in oil in, the U.S. And that also should lead to potentially higher oil prices, which then could help some emerging market countries that tend to be, oil exporters as well. So for people saying that there is no medium-term structural growth driver to support, a continued either EMFX trade or weaker dollar trade, I would point to those two potential candidates as future underwriters, to growth, and that all of those items that I just described kind of underline the view that near term, I think we're still in a choppy, environment where we're going to have to tactically pick our spots, starting in developed market currencies, moving into emerging market currencies. But we are building to potentially a much bigger or more structural trade for dollar weaker and much higher allocation to international markets.
Thanks, Bill. And certainly to watch will be, President Biden's, physical and social infrastructure plan, both from a fiscal deficit perspective, as well as, how that build out can help benefit commodity producing countries in emerging markets. So, we'll have to see how much of that infrastructure package can get passed and how much offsetting taxes we'll see on the other side of it. We've ran a little bit over in terms of our questions, so I do want to get to some of the audience Q&A. Here's one question coming in related to DoubleLine. So how has working from home during the pandemic changed the investment process? And, how has the communication been with the team? For whoever wants to answer this one.
Do you mind if I start? And then I'll let Bill and Luz jump in, given that a lot of what I'm engaged with during day in and day out is with the analysts and the credit work that's done. After just a short period of time, we're all up and running at home with multiple monitors and complete access to everything we had at work. One thing we noticed, and we just started tallying this recently, is that we actually, you asked a question. Let me just go back. You asked if our investment process changed. The investment process hasn't changed at all. We have a process. We still go through that process. How we actually do our work is a little different because we haven't had any in-person meetings with either clients or companies coming to our offices or traveling abroad to go visit the company. So that's been put on hold for now. But we've actually gotten more work done. We tallied up 450 credit reports done in the last year, highest we've ever had. We have Monday, Wednesday, Friday meetings on Teams, and we're actually reviewing more credits than we ever have. Probably a few less distractions from home, although the occasional family members walking in and demanding time, I'm sure, is happening to everybody who's had to work from home. But in general, it's been quite successful. The only thing I would add is that we still would like to get back to the office at some point because there's just that benefit of being together. And the only drawback I've seen is our meetings, when we schedule them, they're great because everybody's ready. When we're at the office and we need a quick impromptu meeting for something, it's much quicker. You can almost pull that meeting together within just a few minutes because you can stand up, look across all of the cubicles that we've got out on the trading desk, the stations, and say, okay, we're going to have a meeting for this. Everybody come on together. Now you do have to reach out and hope to catch everybody. It may take a few minutes, maybe an hour longer or two. we still have them, but it's not a huge issue. But that is one thing that I would say has been a little weaker. But the extra few hours we get from not having to travel to and from work, I think, is just being put into work. So I think we've done a pretty good job, much better than I thought we were going to do when we started into the process.
I do miss the trade desk banter back and forth, though, and hearing about everyone's kids on a daily basis. It's hard to call you guys on Teams and ask, how your kids are, or where you went to dinner. It doesn't seem right, but much easier to ask on a trading desk. So that's something that I really miss. Here's an interesting question that came in. Due to COVID, the gap between the rich and the poor has widened in emerging market countries. Do you think socialism might occur in the next elections, and thus increasing risk in EM? For anyone who wants to tackle that one.
I'll maybe take the first stab at it, and then Luz and Mark, please, jump in as you feel necessary. But I think we're starting to see some of those elements. The elections in Peru would be the ones that immediately jump to mind, where we're seeing Pedro Castillo as a socialist candidate who surprised to the upside, and he continues to surprise in polls over much more traditional candidates. Now he's facing Keiko Fujimori in the second round, who is much more of a market candidate. But from what I've seen so far, she really still is at a deficit compared to what the socialist candidate has. I absolutely think this inequality issue is something that is continuing to grow. I think that, rightly so, people are trying to demand accountability from politicians on, what their policies are, the amount of corruption in the system, and all. And when we look at countries, one of the items that we evaluate is institutional strength. And do we have an independent judiciary that can protect the rights of the people? Do we have policy-making institutions that are generally doing the right thing? Is there a control of the level of corruption in these countries? And I think that there was there was a bit of the inequality issue is kind of an artifact of where some of the weaknesses have been for countries that have had institutional strength issues. And I think that this is probably a trend that we're going to be seeing going forward, and we need to keep a very close eye on, and will lead to differentiation across returns, not only in the emerging markets, but in the developed markets as well.
Yep. Luz, did you want to pick up on that?
Yeah. And, one of the things that I would say is this income inequality sort of was revealed, not just in EM, it's been globally. Certainly we felt it here in the US, and it's been much talked about, in the news here locally. So I do think that, that is a problem. But at the end of the day, I think when you think about, the policies and that most of the countries within our asset class are pursuing, we do expect to see an overall improvement in terms of income, per capita income. So as GDP grows, as the country becomes more wealthy, you do start to see it, come down sort of to all different levels. And certainly this pandemic has hit emerging markets hard. It's certainly increased the poverty levels within a lot of our countries. But again, this is not, a short-term process. It's an evolution that's going to continue. We do believe that a lot of these countries have significant resources to be able to continue to grow their economies. And that's why, we've been very much committed to this asset class and believe that this is a secular improving credit story. And so when I think about this asset class, when I think about, the potential that it still has, just given the natural resources, given, the populations, given sort of the cycle that it's in, I think it certainly can continue to improve and bring a lot of people out of poverty. Again, it's not going to be, easy. It is going to take time, but it is something that I think, that's what most people want. And in terms of, the expectation for what you can get out of this asset class, I've always thought that, in the medium to long term, returns in this asset class in the mid to high single digits seem reasonable to me, given, the current starting base of treasuries and spreads. So, from the perspective of, everything that we've seen so far and, what returns have been over the last decade, certainly within that threshold range.
Thanks, Luz. So we have reached the 1 hour mark. I wish we had more time to continue this discussion. For the questions we didn't get to, we'll certainly try to reach out. Thank you so much for everyone joining us here today. Thank you, Luz. Thank you, Mark. Thank you, Bill. Great to be here with everyone today. And we're signing off now.